Hey traders, in this video I want to go over how you can hedge for basically free. And when I mean that is there's always some risk in trading and there's always some cost, but what you can do is have a net debit or credit as zero by putting on what I like to do, a bearish risk reversal, or I should say a limited bearish risk reversal, because we're limiting our risk by doing spreads. So let's get to it. So I'm looking at the SPY right here, and why the SPY is because it is very, very liquid, about penny wide options. And you can do this with your favorite stock, you can do this with the QQQs, IWM, SPY, whichever you like. But what I'm going to do on this is I'm going to go to the March 5th expiration options, which expire in 8 days, so next Friday. And what I can do is I want to sell a bear call spread, right? So I'm going to collect some premium here. And all I do when I sell a bear call spread is I'm saying I don't want the stock to go up this much, or to this amount. So I'm going to go ahead and sell the 395 calls here in the SPY. So let's go ahead and do that. And those are about $1.11. And I'm going to go ahead and buy, if I hit control down, the 396 calls. So I'm doing a $1 wide bear call spread here. And I can get about 23 cents credit in. So if I do that, I'm going to go ahead and I will say sell one vertical SPY, also known as a vertical spread. And I'm risking $77, so I can only lose. My max loss is $77 per one contract, and my max profit is $23. Now, what are the chances that the SPY goes above 395 by next week? Very low. That's why I'm only getting that $23 here. But what I can do is this. So I'm going to take that 23 bucks if I want to get filled on it, which I already have, as you can see the screen here. And I can use that credit to now finance a bear put debit spread. So I got a credit of 23 bucks. So now I'm going to go ahead and try to find a bear put spread. I already have the 386, 385 on, but let's see if I could find one that's equal to 23 cents. So let's try the 384, buying those puts and selling the 383s. They're about 29 cents. Let's do something, maybe buy the 383 and sell the 382. I like doing $1 wide. Almost there, close but no cigar. Let's try the 382, 381. There we go, almost 23 cents. So I can do this trade for basically free, and I have protection now. If the SPY goes below 382, and then I subtract the 23 cents I paid, so what's that going to be, about 381.77? That's my break even for the spread, which I can make now $23, or I'm risking only now $23 if I put it on, possibly to make $77. So that is a fantastic way to get hedged without having to get perfectly directional. Because let's say the SPY stays exactly where it is, let's say 386. Well, that bear call spread that I sold, the 395, 396, I'm going to get that full 23 cents, and it's going to go to zero, so I collect that full 23 bucks. And the 382, 381 bear put spread that I bought, well, it's going to go to 23 cents to zero because the stock did not get below 382. So no harm, no foul. I just basically hedged for free, and I still had downside protection in case the market started to collapse. This is what is called a bearish risk reversal, but we're doing this with spread. So we're doing a limited risk bear risk reversal. Normally a bear risk reversal is selling a call to finance a long put. In this example though, we always want to limit our risk, therefore trade spreads. We never sell naked options. Don't get caught with your pants down, guys. And we can do this to hedge. If you don't want to sell the upside call spread, you could just buy the bear put debit spread, and you're getting a favorable risk versus reward. Basically, you're risking about a quarter to potentially make 3/4. How do you not love that as a hedge?